While much of the world was distracted by headlines celebrating silver's historic breakout earlier this week, something far more disturbing was unfolding behind closed doors. This wasn't ordinary trading activity. It was damage control. Late at night, away from public view, senior exchange officials and executives from the largest bullion banks convened in an emergency meeting. Their conclusion was simple and terrifying for them. The market was slipping out of their control. Silver had pushed through the $75 level, and internal projections pointed almost directly toward $100. That trajectory wasn't just inconvenient, it was catastrophic. They faced a binary decision: absorb massive losses and risk institutional collapse, or rewrite the rules mid-game and shift the cost onto everyone else. They chose to rewrite the rules. Just after 3 a.m., a small notice quietly appeared on the exchange's website. No press release, no breaking news banner, no social media announcement. Yet its impact was immediate and brutal. Margin requirements were raised to levels never seen before. This wasn't a routine policy tweak. It was a blunt force instrument designed to trigger forced selling. To grasp the scale of this maneuver, you have to understand how margin works. Futures trading allows participants to control large amounts of silver with a relatively small cash deposit. That leverage functions smoothly until the entities on the wrong side of the trade start bleeding. The overnight rule change effectively demanded that traders suddenly post vastly more capital just to keep positions they already owned. Imagine buying a home, finalizing the paperwork, and then receiving a call the next morning saying, "We've changed the deal. Bring tens of thousands more in cash by noon, or we seize the house." That is precisely what thousands of traders are facing now. They're not being liquidated because silver fell. They're being liquidated because the rules shifted. The result is a manufactured sell-off engineered to rescue deeply exposed institutions, most notably J.P. Morgan, from insolvency. And even that wasn't enough. Reports began surfacing across brokerage platforms: buy orders failing, purchase buttons disabled, accounts restricted to close-only mode. Traders could sell, but not buy. Sound familiar? It should. This is the same script used during the GameStop episode. When buying is blocked but selling is allowed, price discovery dies. The market can only move downward. This is not capitalism. It is controlled price destruction. At the same time, massive sell orders began appearing on the order book. Huge blocks of silver offered just above market price, designed to intimidate buyers. But these orders were illusions. They vanished milliseconds before execution. This tactic has a name: spoofing. The goal isn't to sell metal, it's to manufacture fear. It's visual propaganda aimed at convincing participants that supply is overwhelming demand, even when the opposite is true. It's psychological warfare conducted through algorithms. And what about the exchange itself? The exchange is supposed to be an impartial referee. Instead, it is structurally entangled with the very banks it claims to regulate. Its leadership is stacked with former executives from institutions like J.P. Morgan and Goldman Sachs. When rule changes appear overnight, they aren't acts of neutrality, they're acts of self-preservation. In that moment, the exchange forfeited its credibility. The so-called paper market ceased functioning as a price discovery mechanism and revealed itself for what it is: a casino where the house ejects players who start winning too consistently. We've seen this movie before. In 1980, when the Hunt brothers drove silver toward $50, the system responded by banning buying altogether. Prices collapsed soon after. But today's environment is fundamentally different. Back then, demand was speculative. Today, it's industrial. Manufacturers cannot be told liquidation only. Tech giants, EV producers, solar manufacturers. They need physical silver to operate. No rulebook can override physics. The most revealing evidence of manipulation lies in the widening gap between paper prices and physical reality. Try sourcing large silver bars today, and you'll encounter premiums of 40–50% above the quoted spot price. That's because the screen price no longer reflects availability. It reflects agreement among insiders. There are now two prices, the institutional number and the real-world cost. And buried within the exchange's legal framework is an even darker option: force majeure. In plain language, it allows contracts to be voided during emergencies. If pressure continues, the exchange can simply declare it cannot deliver metal and offer cash instead, based on yesterday's manipulated price. That's not settlement. That's expropriation. Yet turn on financial television and you'll hear nothing. No investigation. No urgency. Instead, silver is dismissed as a fad, a meme, a bubble. The silence isn't accidental. It's sponsored. The largest advertisers on these networks are the same banks facing existential exposure. Why such extreme measures? Because the short positions are enormous, possibly historic in scale. If silver sustains prices near $100, losses could overwhelm capital buffers. The implications go far beyond a single bank. Regulators know this, which is why enforcement suddenly becomes flexible when systemically important institutions are at risk. This isn't just market intervention, it's coordinated survival. Meanwhile, outside Western control, China is watching closely. The Shanghai Gold Exchange plays by different rules. When prices are artificially suppressed in New York, physical metal flows east. Chinese authorities have actively encouraged precious metal accumulation, quietly draining Western reserves while paper games continue. Ironically, manipulation accelerates the very shift it aims to prevent. Industrial users are also losing patience. Futures markets are supposed to provide stability for planning and hedging. When those markets become unreliable, corporations bypass them. There are growing signs that manufacturers are negotiating directly with miners, cutting the exchange out entirely. If that happens, the exchange becomes irrelevant, just a venue for synthetic bets detached from reality. Instead of intimidating investors, these actions have enraged them. Capital is leaving the system. Physical demand is rising. This is no longer just a trade. It's a statement of distrust. And the behavior we're seeing is not strength. It's panic. Power doesn't need to cheat openly. Desperation does. The fundamental problem hasn't changed. Silver supply is tightening. Ore grades are declining. New discoveries are scarce. Consumption outpaces production. No amount of paper can reverse geology. Hidden leverage in off-exchange OTC markets only magnifies the risk. The true exposure may be many times larger than reported. Rising prices and interest costs are squeezing these shadow positions toward collapse. Yet every ounce removed from circulation weakens the system further. This is approaching an end game, not because of speculation, but because of math and material limits. Paper prices can be pushed around temporarily, but eventually reality asserts itself. The conclusion is unavoidable. Either the system reforms or it breaks, and when it breaks, the divergence between paper promises and physical assets will close violently. Currencies will absorb the shock. Bailouts will follow. Purchasing power will evaporate. Those holding real assets will weather the storm. Rule changes are not proof of defeat. They are proof of fear. They halted buying because they are losing control. They changed margins because the fundamentals no longer favor them. The more extreme the intervention, the clearer the truth becomes. This isn't the end of the squeeze. It's the final phase.